Welcome back to the Deep Dive. Today, we're jumping right into the latest weekly market brief from a major financial institution. Our mission, as always, cut through all that noise, pull out the really important bits of insight, basically give you a shortcut to understanding the key economic stuff shaping things right now. No need to wade through pages of dense analysis yourself. And just to set the scene a bit, there's this really surprising thing in the sources. If Federal Reserve is doing this critical balancing act, almost acrobatic. And one single data point recently didn't just tweak things. It seems like it completely rewired how the market thought the Fed would move next.
Yeah, it's what this brief really highlights is that tightrope walk central banks, especially the Fed, are on. They're always trying to hit that sweet spot, strong jobs, stable prices. And that's a huge challenge when inflation's still kind of high, this report. It gives us a really clear look into that struggle, especially when unexpected data throws a wrench in the works.
Okay, let's unpack that. The Fed's big dilemma. Anyone following Fed policy knows markets were, pretty nervous before the latest jobs data came out.
Yeah.
What were the main worries? What was everyone sort of bracing for?
Well, markets were definitely worried about growth. That was the main thing. We'd seen unemployment claims tick up, right?
Mm-hmm.
And that led a lot of people to think, okay, slowdown's coming, rate cuts might need to happen faster. There was this real feeling that any weak jobs number would put the Fed in a really tough spot, kind of force their hand on cutting rates sooner rather than later.
Right, and this is where it gets interesting. The actual June jobs numbers. What did they show? How did they surprise everyone, given those expectations?
Oh, the numbers were pretty striking, really. The consensus, the average guess, was for payroll growth to fall way down, like to 110,000 jobs.
Okay.
But the U.S. economy actually added a pretty healthy 147,000 jobs in June.
More than expected, then.
Yeah, quite a bit more. And crucially, the unemployment rate didn't go up. It actually fell back to 4.1%.
Huh.
So the immediate takeaway from that stronger report is, it's pretty big. It basically makes the Fed's immediate decision simpler, considerably simpler. It means they can feel more confident sticking to their current plans, staying on hold for now, pausing rate changes. When the labor market looks healthy like this, there's just much less pressure to rush into rate cuts. Buy some time.
That seems pretty clear cut then. But you mentioned earlier the whole U.S. tariff policy thing.
Mm-hmm.
That makes things murky, right? How does that uncertainty about inflation from tariffs complicate things for the Fed? Does it make this on-hold stance feel less like confidence and more like caution?
That's a really good point. It's a critical layer here. The Fed's dealing with multiple signals, and sometimes they conflict. So the strong jobs report is one piece, gives them some breathing room. But the inflation impact from tariffs, that's still a big question mark, a wild card.
Right.
Tariffs could push import prices up, adding to inflation. But they could also slow down the economy, dampen demand, which would actually reduce inflation.
So it could go either way.
Exactly. And because it's not clear-cut, it just adds to the Fed's caution. So on hold isn't just, hey, jobs are good. It's also, let's not make a sudden move that messes things up with these tariff effects we don't fully understand yet. Deep caution is probably the right word.
Okay, got it. So let's bring this back to the listener. What does this mean for you? Why would a strong job market actually be a reason for the Fed not to cut rates? How does that ripple out to individuals, to businesses?
Right. It seems counterintuitive sometimes, doesn't it? A strong job market sounds good, but from the Fed's perspective, a really robust job market signals a strong economy. And if the economy is running hot while inflation is still a worry, cutting rates could overheat things even more, like pouring gasoline on a fire, potentially.
Ah, okay. Risking higher inflation.
Exactly. So for you listening, this means borrowing costs, think mortgages, car loans, business loans, they might stay higher for longer than maybe you thought a few weeks ago. But the flip side is it reflects an economy that's holding up, that's generally good for job security, maybe wage growth, consumer spending power. It's always a trade-off.
So the U.S. picture is clearer, Fed gets some breathing room, but we know it's a global economy. Let's zoom out. What does the brief say about the wider world? What key things should we be watching this week? Absolutely.
Got to look globally. The week ahead section flags a few important data points. On Monday, we've got Eurozone retail sales for May. The last reading was 2.3% year on year. Gives us a sense of the consumer there.
Okay.
Also Monday, Japan's average cash earnings also was 2.3% last time. Key for wage growth, inflation pressure over there. Then Wednesday, China's headline inflation for June. The prior reading was actually negative, minus 0.1%, so watching for deflationary signs.
Interesting.
And Friday wraps it up with the UK. We get their GDP growth for May, previously negative 0.3% month on month, and UK industrial production, also negative more 0.3% previously. So a crucial check on the UK's economic health.
Okay, connecting that forward-looking stuff to the bigger picture now. Brief gives current GDP and inflation numbers for major areas. What do these tell us? What jumps out at you in terms of contrast between regions?
Yeah, the contrasts are really quite something. It's like different economic stories playing out everywhere. Look at the U.S. GDP growth, reported at minus 0.5%, but CPI inflation still at 2.4%. So negative growth, but lingering inflation.
Stagflationary vibes.
Sort of, yeah. Then you compare that to China. Positive GDP, a solid 4.9%, but negative headline inflation at minus 0.1%. Completely different dynamic.
Wow, yeah.
Japan, too, negative GDP, minus 0.2%, but surprisingly higher CPI at 3.5%. The Eurozone looks maybe a bit more, I don't know, normal. GDP, 2.5%, CPI, 2.0%, and the UK, 3.0% GDP, 3.4% CPI. What's fascinating is just how differently growth and inflation are behaving across these major economies. It implies really varied challenges for policymakers, but also different opportunities and risks for global trade and investment, right? Some fighting inflation, some may be worried about deflation. It's a complex map.
Okay, so that's the economic backdrop. Complex, varied. How are investors reacting? Where are they putting their money? Let's dig into the markets, equities, bonds, commodities. What's the reaction been?
All right, starting with stocks, equities. The big picture, MSCI AC World Index is up, gained 1.2% last week. It's up 8.2% since the start of the year, and 13.4% over the past 12 months. Pretty solid.
Okay.
But drilling down, you see some interesting regional stories. The U.S., the S&P 500 had a good week, up 1.8%. It's up 7.5% year-to-date, 14.9% over the year. But look at Europe. Some markets there are really flying. The German DAX up 19.5% year-to-date. Spain's IBX up 24.1% year-to-date.
Whoa, really outpacing the U.S. then?
Significantly. Suggests maybe a strong catch-up trade or rebound story playing out there. Emerging markets overall are also doing well. MSCI EM index up 11.7% year-to-date. Brazil, part of that is particularly strong, up 18.1% YTD. China's interesting, though. The MSCI China index was actually down 1% last week, even though it's still up a strong 17.8% year-to-date. So maybe some recent profit-taking or specific concerns there.
And sector-wise within equities, any standouts or laggards?
Yeah, sector performance shows where the bets are. Industrials are up 13.2% YTD. Financials up 14.3%. Tech up 8.5%. Those are strong performers. But then you have some sectors actually down for the year so far. Consumer discretionary is off 0.8%. Healthcare down 1.0%. So definitely not uniform strength.
That's a lot happening in stocks.
Yeah.
What about the bond market? You mentioned spreads and yields. What are they telling us about risk appetite?
In bonds, the general trend for spreads, that's the extra yield investors demand for riskier debt, has been narrowing. We see that across global investment grade, emerging market debt, global high yield.
Okay, narrowing spreads means less worry.
Typically, yes. It suggests investors perceive less risk. They're demanding less of a premium to hold that debt. Now, the U.S. 10-year Treasury yield, a key benchmark, is at 4.34%. That's actually up a little, 5 basis points from a week ago.
Right.
But it's still down 23 basis points since the start of the year. So maybe some slight short-term upward pressure on rates. But the bigger trend this year has been yields coming down a bit.
Got it. And while we're tracking assets, commodities often tell a story. Anything surprising there? Gold, oil.
Oh, absolutely. Gold has been, well, really impressive, a standout story. It's trading around $333 an ounce. That's up 1.8% just last week, up a massive 26.9% year to date.
Wow.
And over the past year, up 41.2%. That's a huge move.
What does that usually signal, such a strong gold rally?
It often signals underlying anxiety, or investors seeking a safe haven, maybe worried about inflation long-term or geopolitical risks. Even when stocks are doing okay, that kind of gold strength is notable. Also worth mentioning, Brent crude oil, sitting around $69 a barrel, up 1.5% last week.
Okay. And quickly on currencies, any major shifts we should note?
Not dramatic shifts, but the dollar against the euro moved a touch. It's now $1.18 per euro from 1.17 last week. So a slight bit of dollar weakness there. The yen is still worth watching, 170 yen per euro, 145 yen per dollar. Those levels are significant.
And finally, just a quick check on market fear, the VIX index.
Yeah, the VIX, the volatility index, is sitting at 17. That's up just slightly from 16 last week. Not panic levels, but a small uptick in expected volatility.
Okay, so putting all those market numbers together, equity strong in places, bonds suggesting less risk overall, gold soaring, volatility slightly up. What's the big picture takeaway? What are investors actually betting on here?
It's a fascinating mix, isn't it? It almost feels like cognitive dissonance in the market. You have investors clearly confident enough to push equities higher, especially in Europe and some specific sectors. That's a growth bet.
Right.
But at the same time, they're piling into safe havens like gold and maybe hedging a little bit with that VIX tick up. It really speaks to this deep uncertainty still lurking beneath the surface. The market seems both daring and defensive simultaneously. They're betting on growth continuing in pockets for sure, but they are absolutely not throwing caution to the wind. Defensive plays are still popular.
Beyond just how markets performed, the brief touches on valuation, how expensive things look. It uses forward PE ratios, what do those tell us? And why should you, the listener, care about whether the S&P 500 looks expensive?
Right. The forward price-to-earnings ratio gives you a sense of how much investors are paying now for expected future earnings. It's about expectations. So the S&P 500 is at 22.6, MSCI World at 20.0. These are, historically speaking, on the higher side.
Implying high expectations for future profits.
Exactly. Investors are banking on really strong earnings growth down the line to justify those prices. Now compare that to, say, MSCI Europe at 14.6 or MSCI Emerging Markets at 12.9, much lower PE ratios.
Suggesting lower expectations or maybe better value.
Could be interpreted either way. Less expensive, perhaps implying more modest earnings growth expectations or potentially more room to run if earnings surprise to the upside. So why should you care? Well, if you're investing, understanding these valuations matters. A high PE like the S&P's could mean higher risk if those optimistic earnings don't materialize. Future returns might be lower compared to markets with lower PEs, all else being equal. It helps you gauge potential risks and rewards. Headwinds versus tailwinds.
Okay, let's wrap this up. We've taken a pretty deep dive into this market brief. We saw how that surprise U.S. jobs report gave the Fed some wiggle room, letting them stay on hold more out of caution than pure confidence, it seems. We explored the really different economic heartbeats around the world, the mixed market signals soaring gold alongside strong European stocks, and these varying valuations.
And really understanding how these pieces fit together, the jobs data, the Fed stance, global trends, market reactions, valuations. That's the key. It's about spotting the patterns, the contradictions, and asking, okay, why does this matter? For you, it's about connecting those dots to get a clearer picture of what might be coming down the road.
So as we finish up, here's a final thought for you to chew on. We saw the U.S. had strong job growth, letting the Fed stay put. But we also saw negative U.S. GDP growth reported for the same kind of period. Given that puzzling mix, strong jobs, shrinking economy, what do you think are the biggest challenges or maybe even opportunities facing the U.S. economy right now? Something to ponder.